welcome everybody to the third Mattereum physical asset NFT meetup. Today's topic is the physical asset Web3 ecosystem. With a particular focus, we're going to have a panel a little bit later focusing on real estate and how that relates to the ecosystem. Welcome everybody. My name is Anton. I'm the managing director at Mattereum, and I will try to keep us to time today. This event is being recorded and it will be released on social media. So by attending, folks are agreeing to having their to appearing in this recording and having that image appear there. During the conversations we're going to be having, there will be the opportunity for the audience to interact. You'll be able to post questions in the chat or in the Q&A, or afterwards, after the formal part of the event concludes, we're going to move across to a different Zoom, which will be an open Zoom where it'll be a kind of after party and folks will be able to speak with each other and interact with each other. But during the event itself, Ketan, my colleague Ketan, is going to be monitoring the chat and the Q&A for questions, and he'll be doing his best either to answer some of them or to refer them up to the panelists, to the presenters to be able to answer, and I will do my best to ask as many of those as possible as we go through. Vinay is going to be the main interlocutor with our guests and leading and facilitating the conversations. And I should also add that there is going to be a POAP, a proof of attendance protocol NFT, which folks will be, there's a limited number of them, folks will be able to get that. There will be a link posted at the end. And one more thing, we are going to have, I think in the chat, we're going to have a Google sheet made available. So those audience members who are not speaking, who are not on the stage, who would like to share their details with everybody and would like to interact with others, you'll be able to put your details into that Google sheet. And people will be able to find you, they'll be able to find who you are, and they will be able to connect with you. Without further ado, let's move to our first speaker, who is Toby Lewis of NOVUM Insights. Could we get Toby's slide up, please? So Toby is a great friend of Mattereum, and his company NOVUM Insights has been researching the Web3 space for a number of years. Toby has a real kind of eagle-eye view of the entire ecosystem, and of course the physical asset NFT space is very much part of that ecosystem.
So yes, so this is a real honor to be able to be presenting on real-world assets on the blockchain in front of Vinay, who has done a huge amount to inform my thinking on the topic. So I'm Toby Lewis, founder and CEO of NOVUM Insights. We're a research group that's been focused on the DeFi and crypto space for the last 6-7 years. Also recently set up a fund called MetaLink Capital that effectively we've been investing in DeFi and crypto strategies, looking for a sort of diversified return. Obviously, real-world assets, I think, are going to be a very, very interesting asset in the crypto landscape because they give possibilities for uncorrelated returns. So I know this is likely to be a very informed audience. So some of the 101 slides at the beginning, I'm just going to skip through very quickly, but essentially, we're talking about the domain of tokenization. Obviously, you've got currencies, financial assets, commodities, art, and real estate among those that have been driving forward tokenization. and obviously you've seen the volatile fungible tokens, stable coins, NFTs as some of the outputs of that. And I think what's super, I think everyone who's dealt with Vinay and dealt with Mattereum realizes that the tokenization of the physical world is likely to be one of the more exciting elements of all that we've been building in blockchain and crypto. And I think we're very, very early days in that. So in terms of sort of a rough sort of number overviews of the tokenization market, stable coins now make up more than $100 billion of the crypto market, showing how new assets can come in. There's a feeling that the on-chain asset tokenization market before this year was estimated at 2.3 billion. And I suspect has performed relatively well in this crisis just because of the nature of the assets having real value as opposed to some of the tokens and other sort of more speculative NFTs that may fluctuate. And according to the bank asset manager State Street, that all financial markets will have to digitize their processes and tokenize their assets to remain relevant. So it's probably fair to say we're in a multi-trillion-dollar opportunity with the tokenization of real-world assets, and it's fair to say that Mattereum has a good claim to be at the center of that among many other new innovative projects. I mean, there's some ballpark numbers. This from my analyst, I think it may be a bit low, but the feeling is the NFT market will be doing $8 billion in revenue by 2027. These are numbers from Statista, and the art market has been fluctuating up and down. So in some ways, sort of why tokenize physical assets, and it's always a challenge to say this sort of stuff in front of Vinay and the like, because I'm sure you've come up with many other good reasons, but allowing for faster settlement, new ways of monetizing valuable physical objects, fractional ownership in the longer term, although there's obvious security risks that I've talked long and hard with Vinay about. And at the end of the day, I think one of the really exciting things of the crypto market when it's working well, it's fair to say that now isn't that best time, but with FTX and other scandals hitting the market, but in many different ways, I think it's fair to say that the token market does bring more liquidity, and I think that anyone who's dealt with people in the art market or the media or people who, some of the projects that are most fascinated by what Mattereum does and what other intelligent groups trying to tackle the NFT market do, there's huge scope for creativity within the token market. Some of it slightly unfounded, and there's good reasons for that, but I think people have been very creative in what they think is possible on chain, and groups like Mattereum are doing good stuff to make that real. There's lots of other groups beside obviously Mattereum, who I'm sure we're going to be hearing a lot more about. There's the likes of Paxos, which worked on its Pax Gold asset-backed token, and I know that Mattereum also has some work on that field. You've got Symphatix and its work on digital securities and the derivatives that it's creating was an extremely hot project at the beginning of this year, late last year. As is the nature of these things, I think it's fluctuated, but has a lot of the developer community. We've got Boson Protocol doing a lot out here in London. looking at that sort of value in the metaverse. And I mean, you could add in Decentraland and Sandbox and a lot of the groups building in and around those kind of metaverse domains as other groups that you might add to the list here. Very interestingly, I helped advise Night Dragon in their early days, and they've now managed to tokenize 140 million real estate in Greenwich. Obviously, Mattereum's done its own work on real estate as well. I'm sure we'll hear about that later. Then you've even got, if any of you have been hanging out in the finance world or even read books on finance, the well-known barbarians at the Gate, KKR, have also got involved at tokenizing a healthcare strategic fund with Securitize, who are probably one of the better known security tokenization platforms. And here in London, you've obviously got the likes of Archax and many others. As you can see here, so our analysts tried to document some of the people out there, like Mattereum, multiple groups pushing on the gold angle. You've got the Polymaths and the T-Zeros and these incredibly well-funded security tokenization groups that have been popping up, trying to tokenize securities, and probably some of the most exciting securities in there are really in the sort of real world asset space. And I'm sure we'll hear from Vinay and Anton and co, the very good reasons for that. I'd say from a financial perspective, what I guess is very interesting for us when we think about real world asset tokenization is I'm always on the lookout for assets that are generally uncorrelated and likely to be uncorrelated to the crypto market. So what I mean by that is effectively, sadly, when playing around with a lot of crypto, it fluctuates with the price of Bitcoin and Ethereum, and to a certain extent end up being Bitcoin and Ethereum derivatives. I've had many chats with Vinay on the subject. The good thing about real world assets is clearly they should detach from some of that volatility, although as we know in the early phases, and crypto is a very young market, some of that volatility will happen in the short term, even to these assets, despite them getting attached to gold or whatever, just because of the nature of the market. But I think what longer term, a lot of these assets will trade in an uncorrelated way to the wider crypto market and the wider financial markets, which in turn will help investors and unlock new asset classes. You've obviously got some of the luminaries in the DeFi space that have made moves in RWA as well. So MakerDAO and Aave, working with Centrifuge, have done experiments in this space. I think we're super early in a lot of this stuff, and Mattereum's one of the groups at the forefront pushing this forward. So super exciting generally. And then intriguingly, our analysts kind of looked at some of the front ends and pulled up Centrifuge as an example, just I think for an example of how different little things are going to be put in a real world asset market. So intriguingly, they sort of have a broad real world asset market, silver, real estate, and then the gig economy and stuff like that. And I think you're going to get a lot of bespoke attempts to create new assets in this field, but it's sort of really, really early days, and it'll be interesting to see how, for example, that tokenization of the gig economy pool or harbor trade or whatever, how they actually play out. And obviously, I know that the Mattereum people, and I'm sure many of the folks here, worry there may be some legal technicalities and difficulties in a lot of these things. But I'm gonna stop there and really open the floor to questions.
Thank you, Toby. I think Vinay has a couple of questions for you.
Yeah, so I mean, with the growth of the space, the fundamental question has to be, why do this stuff tokenized rather than trading it on existing exchange infrastructure like Chicago Board of Trade or something like that? What do you think the advantages are of tokenization, at this kind of fundamental level? Yeah,
so I think there's the first thing is, I think there's huge barriers to entry in those markets, right? Like the costs of putting something up in a fully regulated area and it can be in the millions of pounds, right? And I think that what always interested me about Mattereum and other groups is you were talking about William Shatner figures or whatever, right? So memorabilia and things that would be in the 10 to 100 grand asset class sometimes.
Even lower.
And I'm sure much more. But the interesting thing is actually like you've articulated to me in the past of it being almost like a higher value eBay in some ways, and I think there's a middle ground that tokenization serves really well, and then there's obviously the permanence and many of the great things we know about the blockchain that unlock creativity. And then I also think one of the things about the crypto market is it is that interesting regulatory gray space where experimentation is possible, right? Like, so I think there's many bad things about that, but what you also get is the possibility of a Petri dish approach, which I think is quite exciting. And so people opting into this domain allowing themselves to be experimental. And I think on any of those sort of truly regulated venues, I think they're going to borrow from some of the experimentation that we've been doing in like the full-on crypto space, and then build on it and go, right, that's ready for prime time. But obviously, I think there's the other advantages of just the blockchain, right? And I know there are many people on this call that can really articulate that in a good way.
Yeah, I mean, particularly when we look at things like Archax, it's pretty clear that if Archax proves that there are good markets to be had in those kind of regulated securities, you can easily imagine some group like London Stock Exchange, picking those ideas up and building on top of them. We also haven't talked about Valerium, who are friends of ours who are talking about building a fully regulated securities market for tokens in Gibraltar under the Gibraltar Stock Exchange banner, and those kind of things. Like, if you wind up with an exchange in Gibraltar doing that kind of stuff, it's easy to see that could spread to other jurisdictions, and you would wind up with a general upgrade in the way that stock markets operate. Yeah, and I think it really is. There's a lot of statement of intent. I can tell that security tokenization is one of the hot themes for the next few years, and I think it's kind of and I think there's more legs. I think often when the crypto market goes down, people begin to go, well, what's happening over here in the security tokenization market, the securitizers and the Archaxes and the Mattereums and wherever, right? Like, and I know that obviously you're playing slightly less in that security token space, but I mean, we view ourselves as coming before the securitizers. We help to get the assets locked in, and then that leaves the securitizers with a single NFT purchase, and then they can securitize. It just makes their life so much easier.
But gentlemen, I'm conscious of the time
behind them. So.
Oh, sorry. Say one more time, Toby.
Anton, you wanted to...
No, I was just saying I'm conscious of the time. A couple more minutes, please.
Yeah, no, 100%. So Yeah, no, I think like there's a lot of credibility coming from that space now. If you look at Archax, they got funded by Aberdeen, which is a huge asset manager, right? Like they took over the old Standard Life, among other things, right? Which is an icon of the sort of the UK institutional managing people's savings kind of area. So
yeah, absolutely.
and I know for a fact that like there are, and I think that Night Dragon project where we advised them, that's one of the first of many where you're seeing people go, hey, how do I get a $100 million, $300 million building and turn that into a token? And then you get, we were ideating in terms of like, well, where do you get to with like a kind of almost a tokenized Soho house in the building, so you could get some exposure to the asset price, but almost have the token also grant you access to a cool club as well as owning your property, and you get these weird hybrid ideas that try and build on some of the flexibility of tokenization and the utility of tokenization. And I think we're very early in sort of almost securities having utility and people thinking about that, but it's a fascinating world when it happens.
Yeah, I mean, I think this kind of hybrid value model makes a ton of sense in that it provides almost like internal diversification. You know, if you're paying £1,000 a year to be a member of some kind of club, but that's also giving you an equity stake in their building, this sort of doubling up of utility and a security interest as a kind of integrated module makes a ton of sense, even in things like Kickstarter, right? If you're taking the risk of buying one of the first run of productions that some company is doing, the idea that that also gets you a tiny little equity stake begins to look like a more equitable deal. I remember writing a piece about this kind of stuff very early on in the days of Ethereum called Dog Atheism, which is basically an analysis of what happens when you can do this kind of composable value structuring.
Toby, thank you so much. Thank you for that very comprehensive presentation. And I hope you'll be able to share that with the participants, the information you presented as well.
I'll send it along to
Great.
Andrew and your team and send it away. I mean,
thank you so much. All right. Next, we have a panel with 3 speakers, specifically focused on real estate, which of course Toby covered a little bit in his presentation. And we are very privileged today to have 3 brilliant presenters. We have Yael Tamar from SolidBlock. We have John Belitsky from Balcony DAO. We have Daniel Fallon-Cyr, is it? Sir? From KLASMA Labs. And Dom, if you could please bring the slide up. So I am going to ask each of our speakers very briefly for 1 minute or so to introduce themselves and say a little bit about what they're doing. And then once everybody's introduced themselves, we'll be able to move on to the more detailed conversation. So perhaps Yael, you could introduce yourself and tell us a little bit about yourself.
Hi, everybody. I'm Yael Tamar, I'm the CEO and co-founder at SolidBlock. And as mentioned in the previous, by the previous speaker, we are the pioneers, one of the pioneers in the real estate tokenization space. We focus on securities tokenization with real-world assets acting as the basically acting as a collateral and issuing securities on top, digital securities that can be traded, collateralized, can be combined in structured products and things like that. Thanks.
Thank you very much. John, could you please say a little bit about who you are and what you're doing?
Sure. Thank you for having me. So I'm the co-founder of Balcony DAO, and we are we kind of think of ourselves as a Web3 investment bank in a lot of ways. Our project was sort of born from the need to figure out ways to bring a pretty large portfolio in northern New Jersey and New York City that is about a $2 billion terminal value portfolio of assets on chain. And the idea was, was there a way for us to create more transparency and more liquidity for these assets? And that got us thinking about how we could incorporate the blockchain. And ultimately, we landed on the NFT as the ideal digital doppelganger for real estate to represent these assets on chain, which at the time was, somewhat novel. And our biggest problem at that point was adding enough metadata into this asset to make it actually work on chain. And so we've spent the past year developing our own platform that allows you to tokenize these assets and then fractionalize them. And I think later on in this talk, we'll sort of disambiguate between both.
Yeah, we can get a little bit more technical a little bit later. Thank you very much, John. Daniel, could you tell us a little bit about who you are and what you're working on?
Yeah, great. And thanks for having me. So I'm Daniel Fallon-Cyr, co-founder at KLASMA Labs. My previous kind of background was a product manager in both fintech and proptech for Intuit and VTS. So myself and my two other co-founders, Ben and Alex, started working on KLASMA Labs back in April of this year. So very new and kind of early stage startup. What our kind of goal at the beginning was to tokenize, a physical asset. So we started kind of looking at a boat or a yacht kind of in the bull market. And that's when we got involved with Mattereum and Vinay, kind of reaching out to them, learn more about the space, that type of thing. Both of them kind of worked previously in crypto from 2017. And then kind of as the market shifted, ended up kind of working our way into real estate. And most recently kind of realized that there needed to be some form of standardization or base layer of ownership for tokenized real estate. So we've just released an EIP, like an Ethereum improvement proposal, for kind of a token standard for kind of base level real estate ownership. And then off of that, we're working on standing up a decentralized mortgage protocol for bringing homes on chain within the US right now.
That's fascinating. Thank you very much. I'm sure Vinay has a number of questions for you all.
Yeah, so I guess, this is clearly a very hot topic. I think more or less the entire blockchain space is looking at real estate as possibly being the next thing that happens. And that general perception of real estate is potentially the future of the space, I think, is based on some pretty large structural inefficiencies inside the real estate industry as it currently stands. Could I ask the panelists to talk a wee bit about that? Just, what do you think the inefficiencies are in the existing real estate model that there is the potential for fixing? And I guess, maybe we should talk a little about the St. Regis and the projects that came after that as a starting point.
Okay. I'm happy to talk about the St. Regis.
Yeah,
the inefficiencies. Will be staying here all night. But I think with the inefficiencies, maybe we kind of should stick to the financial side of things in real estate and asset management, right? But with the St. Regis, which was the project that we got involved with in 2018, kind of serendipity / coincidence, my co-founder Yael put together a website saying we're tokenizing real estate, and lo and behold, we actually did. So the situation with the St. Regis was that the asset wanted to recapitalize and elevated returns. The asset manager had a few choices, one of which was the IPO. In fact, they started the filing, they contracted the law firm, and you can even see it on the SEC website, that they started the IPO filing. And then at some point they realized it would cost them $2 million to file an offering for just about 18 million for the recap. And so they then realized, and why in general did they even want to have a public offering or a tradable offering, was because it's a landmark. It's a very stable asset that you do not expect to get some sort of refinancing for 5 to 7 years. Nobody's selling this asset. And so investors, when they were asked if they want to buy the shares, they always would say, okay, great. But when when am I going to be able to sell them back, right?
Right. When does it become liquid? Yeah.
Exactly. So yeah, so that's how they kind of came upon the concept of tokenization, and they contacted us. So we minted the first smart contract. So it was essentially one of the first ERC20 smart contracts that had this KYC AML accreditation kind of gateway. Since then, it has migrated into a different standard like ERC 1404. I think Tokeny might have spearheaded that one. So, you know, that was pretty much kind of the innovation behind that, and an evolution from the early ICO type of contracts, which had no limitation. You could easily, essentially, what is tokenization? It's just basically placing a contract, investment contract, onto Web3, right? So onto the space where onto the blockchain where you can trade it. So the investment contracts until then in the blockchain space were just transferable from one party to the other, no limitation whatsoever, very decentralized. So we actually put the limitation, so it does create an effect of centralization, even though KYC and AML you can technically also decentralize, and there are a few companies working on that. So since then, so after the minting of our contract, actually a year and a half later, Tezos got involved with the project. Those actually Securitize got involved with the project like somewhere in the middle, and then Tezos got involved and they redid the contract. So it's now on private Tezos chain, and it's trading on T0 on Tezos. So that's basically the history for the project.
Gotcha. And what's happening next? You know, what are the plans for future processes, future projects?
For St. Regis or in general?
Oh, in general.
The plans actually, so the industry has evolved, right? That was 3 years ago. And the industry has evolved in different ways. The first is basically a lot of the trading and transactions are now happening on the wallet to wallet level rather than on a platform level. And so, you know, every investor, even though there is a platform where there's an interface, at the end of the day, what they care about is there is a wallet where their information is sitting, where their KYC and AML is located, where their tokens are, maybe where their crypto is, and it's connected to a bank account in some way. So basically, a wallet is your identity, your kind of container where all your assets are, right? And also tokenized bonds and stocks, and you know, even maybe you know, tokenized fiat, which is USDC, a stablecoin, tokenized fiat, right, is sitting there as well, right? So you don't need any other places to really deal with. So that's kind of what's happening. And that's where we're going also with SolidBlock. A lot of the issuers did not want to be on the marketplace. They're saying, you know, we're bringing our investors anyway, so we want to bring our brokers. So the next stage is going to be broker dealers, you know, getting involved, and you know, larger asset managers are going to get involved. And a lot of them just got crypto approved slightly before the FTX fiasco. But I'm assuming they're not going to take that away. So it seems like the industry is going to finally, you know, really go through that kind of jump.
So making the jump to having a complete securities pipeline, and the whole thing begins to look very much like kind of traditional TradFi regulated finance.
Yeah, it is very much TradFi. I mean, that's what it seems like. Crypto has kind of crypto legacy, I would say. You know, led to kind of this. I would say merge between the tech on which crypto is running and very traditional institutions that are now taking advantage of it. And at the end of the day, individuals and company, you know, investors are going to benefit from that as well.
Cool. Thank you very much. John, let me come to you. So you're coming out of the real world, you know, real estate. Now you are in Wonderland. What do you see? What are you up to? What comes next?
Well, I mean, it's really interesting having these conversations with people who are approaching this differently and who are coming from different parts of the world with different regulatory frameworks that are guiding their products and their path to market. From my perspective and from the perspective of Balcony, these are all securities that are traded on exchanges that are regulated by FINRA licensed broker dealers as security tokens, and that's been the only way that we've looked at this throughout our journey, and really the only way we continue to kind of build is under that framework. So the idea that there's sort of wallet to wallet transactions in this completely, self-custody, decentralized way is a little shocking to me, frankly, to think about it in that perspective. The appeal of it is amazing. Obviously in a perfect world, there isn't a regulatory requirement that you move through these markets and you can kind of trade these assets as you like. But our view in the US, at least, is that these assets are subject to this regulatory framework that requires that we use broker dealers. And so that also has benefits, right? So that comes with, a TA that is going to hold on to that asset, and God forbid you lose your wallet or it gets hacked or for whatever reason you don't have access to it. It could be burned and reissued because the entire cap table is also being held with the TA. It's being held on our blockchain. It's being held, in your records. And so we have sort of these redundant protocols in place to safeguard those assets in the sort of broker-dealer worldview. But I don't know that there's a future in the United States, at least, especially following FTX, for assets that are traded in any other way. Even if we wanted it to be different, in my view. So, yeah, I have a question for you. I mean, first of all, I know your company. I know your co-founder, who's a great guy, by the way, and you have a wonderful product. Do you guys have a broker dealer sort of pipeline product where users can actually purchase security tokens through a BD and then trade them and keep their asset with the TA?
So you kind of, I wasn't going to say anything until the new year, but that's pretty much the direction in which we're going, where not only, well, now we do have that. So you can technically, let's say you want to go with a broker dealer. The only difference is that now you have to use escrow, and we have that set up with North Capital already, where the broker dealer will distribute the security. That we already have. But that's just the very beginning. We want to be able to add a lot of brokers, and we want those brokers to be able to add more brokers and reps, so that a lot of, that's what, if we learned anything from crypto, is the power of the community and the power of sharing. Why? Because blockchain enabled us to share, right? Enable us to share in a trustless way. I don't want to have to, as a broker, I don't want to have to track all of these agreements I signed and all these commitments that I entered in, and other people owing me money and so on and so forth. You don't want that. It's a lot of overhead. So the good news is that blockchain is the perfect ledger for keeping track of all those agreements and commitments. Not only that, you can even resell them, right? So that's basically what we want to, what we're doing now is creating this kind of broker affiliation system.
Yeah, so I mean, my perspective is that the blockchain is excellent at hashing those transactions, but not great at managing those relationships. And from my perspective, the NFT is where we unlock the collaborative potential of Web3, because it becomes this container where every single activity relevant to the capital asset lives. So if you have a mortgage, a deed, if you have an encumbrance, if you have, riparian rights that are sold, air rights, if you have a broker dealer that is acting as an affiliate that is selling these securities, all of that stuff lives inside of this NFT. That's both the legal wrapper as well as this sort of folder, for lack of a better word, that speaks to the blockchain.
So
but we're thinking about it.
This would be a good part for Daniel to come in on, because you're beginning to do a whole bunch of work on this. Could you talk us through a little bit about what you're working on, and particularly this new NFT standard that you're bringing to the table?
Yeah, definitely. And so I think at KLASMA Labs, kind of the two fundamental hypotheses we kind of rest on are that people are going to want to transact digitally in real estate, which I think we obviously all agree on, and people are going to want more malleable ownership structures through fractionalization, et cetera. And I think there was a podcast that I was listening to where an investor phrased it really well. And he said, we live at this really interesting point in time where, in our lifetimes, the entire, ledger of the world and transactions, et cetera, are moving from like purely pen and paper to likely purely digital, and what he was interested in investing in was those companies that are going to basically create those rails and create that kind of, structure for digital transactions. So we actually, we take a different approach than both of you. And I'll post the EIP that we just released in the chat here. But our kind of we kind of anchored the EIP to 3 objectives. And one is that these tokens are universally transferable. So I think a key component of DeFi, right, is the trustless and permissionless aspect to it. And that's really what kind of enables the power of it. So universal transferability. The second objective was that all property rights are maintained within the token. So that's the right to hold, right to alter, right to rent, right to occupy, right to transfer, and right to resell. So that those are passed with the token. And then lastly was that those rights are atomically transferable with the transfer of the token. So I think that's really important. So with us, kind of the way that we've structured this is there is a centralized component in the sense that there's an asset administrator who basically acts as a legal representation and owner of the asset. And that legal owner, basically a parent company, would own a bankruptcy remote LLC that kind of protects the asset in the event of any financial distress that they encounter.
Kind of like a standard SPV construct where you have
Exactly.
a layer of SPVs that represent the investor interest. Okay, cool.
And then below that SPV is a DAO. So in the US, where we've started and we've kind of introduced a structure there, is we have DAOs recognized, whether they be in Tennessee or Wyoming. And that DAO is actually what issues the NFT. It's able to be algorithmically managed by smart contracts, and also holds the title and deed to the property. So then that's kind of just the base layer of ownership of allowing any smart contract address to own this property, whether it be a protocol that owns it and a mortgage protocol or a fractionalization protocol. And we kind of see all of that happening on top. So all the securitization aspects happening kind of one layer higher, but really focused on the base layer of on-chain ownership being kind of free and transferable the same way a deed would be today for a property.
Got it. I mean, so Mattereum looked at this entire space, a few years ago when we were just getting started, and came to the conclusion that securitization was a super hard problem that required a ton of like very advanced specialized legal infrastructure. But the custodial function of getting a clear definition of what the property is, getting clean title, getting it cleanly transferred into an SPV, and nailing down all the liability around that, that was a soluble problem for us as a kind of thing that we could tear off and do that would then be of service to the securitization frameworks, the broker-dealers, all the rest of this kind of stuff. It was like a soluble subunit. So, as we've been sort of looking at the development of better standards for NFTs and so on, we've been very aware of like, okay, we want to figure out how to plug into this. Here's a legally sophisticated definition of what the property is, which is being securitized. This is how we plug that legal framework into the NFT. And then on top of that, what we've envisaged is companies which will then take the NFTs and then rip them to pieces into the securitized fragments and then put those onto regulated marketplaces. John, I know you're also working on standardization of new token designs for representing real estate rights. Tell us a little bit about what's happening at Balcony with that.
Yeah, so, firstly, to disambiguate between tokenization and fractionalization for a second, we view tokenization as the digitization of these assets on chain. And that is the first step to fractionalizing them. That is not a security in our view, right? So if you tokenize your home, or a car, or whatever the case may be, and you own it as a 1-for-1 and sell it as a 1-for-1, that's equivalent to selling your home or any other real property.
Whether you sell a painting on eBay or whether you sell a painting on OpenSea, it shouldn't make any difference from a securities regulator point of view. It might in some jurisdictions, but generally speaking, we think that one-to-one ownership is not securitization most places.
That's precisely our view. And so operating under that worldview, right or wrong, let's assume that's correct for a moment. The fractionalization is what triggers the securitization of that asset. And so what we want to do is build a tokenization platform that allows for fractionalization if you care to fractionalize, but we still see huge value in tokenization in its own right. So for example, I might tokenize a building that I own and have all of the data relevant to that asset on the blockchain. And I might do that because, you know, one day I may decide that I want to take a mortgage out on it. And in this newfangled world that we're envisioning, you could take a mortgage out in 5 minutes and you can retire it 30 seconds later because all of the data is there. This asset is a known quantity. All of the metadata that describes the rent, the incomes, the expenses, and the encumbrances is available. And I could permission that for a lender in a second, and they could put a lien on that asset, take their first position, and lend with confidence. And so in our data architecture, what we're trying to create is this model where the asset is a NFT, it's an 1155 in our structure. And inside of it are what we're describing as these fleets. These fleets are essentially a bunch of 721 contracts that are bundled together with very specific uses, right? So for example, leases might be a fleet, and you have every single lease for this property that lives inside of the 1155 as 721s. And every piece of metadata that describes those leases lives within that asset. And so it starts with scanned copies of this, which may be in IPFS, they may be on some, you know, WebTorrent or elsewhere. But eventually our view is that this all becomes bytecode, that some point in the future, we reach sort of like the blockchain singularity or something. And all of these contracts become reduced to actual bytecode that can be executed on chain immediately. And that's sort of where this ends. And we think at that point, we've achieved the kind of liquidity that we're all chasing here in this space. We've achieved the ability to make illiquid assets completely transparent and as liquid as they could potentially be.
I think also, I mean, this is going to be very jurisdiction by jurisdiction. It's easy for me to imagine that, say, Dubai or possibly the Netherlands would get integration between the blockchains and the national property registers early. In other jurisdictions, it might be a little slower, but it would be very, very helpful if you had, you know, digital signatures on documents coming directly out of the property registers that could then be referenced on chain and verified on chain because you could verify the signatures and the source of the documents. Those kind of document-centric handoffs. About 5 years ago, I did 5 years, maybe a little longer. I did the first cut of the national blockchain strategy for Dubai, very much focused around the idea of the government as the provider of a document stream with digital signatures, with a certificate revocation list on that document stream. And that document stream then becomes something that could be kind of seamlessly absorbed into the smart contract ecosystem. Because it just makes sense, right? If you could get government documents with digital signatures on them and you can verify the digital signatures on chain, it allows for a very, very tight, very structured, very neat way of doing these kind of handoffs.
There's also the opposite view of that, though, Vinay, which is, you know, first of all, yes, I agree with you. And that's our objective. We're actually working with municipalities in America to bring those documents, title and deed, directly on chain now to assist it with the tokenization, not the fractionalization. So that fractionalization can move with some alacrity. But I had a very interesting conversation recently that's kind of changed my thoughts on the need for governments to be that sort of firewall and be that validator of that information, which is, you know, if you're a hedge fund and you're going to buy 10,000 single family rental properties, the reason why you need the title and the deed, the reason why that's important for you is because you want perfect title, you want an insurable claim on this asset. But if there's some other entity that is willing to do that for you, it's not as necessary, right? Like
absolutely.
I think we're approaching the point where there are groups that will take the blockchain as the point of truth over the municipality. And so in that case, these transactions will happen on, you know, Balcony's platform, Daniel's and Yael's platform. And then the municipalities will print this to their county records sometime later and nobody will care because you've already received your claim on the asset on the blockchain and your value for it.
Yeah, I mean, this gets into some very delicate issues, jurisdiction by jurisdiction, about the nature of interest, right? If you have an interest in the property, where is the interest in the property recorded? If the property is in an SPV, then the interest can be recorded at the SPV level. If the property is on, in a jurisdiction where the government maintains a register of interest, you could add the interest there. And, this thing of whether we can get information from the government to the chain in an authenticated way in one direction, or from the chain to the government in the other, the bridge infrastructure there is basically law firms and SPVs. If I have a law firm that says, I looked at the government record, I verified what it is. In fact, we did this right now. We have Mattereum has a property which is being sold by one of our clients, mattereum.com/land, you can see it. And the guarantee of title is from a law firm that has basically examined the situation and says, right, we guarantee this is clean title, and if it's not, you can claim against us. We're making that guarantee. And at that point, the difference between a law firm standing on putting its insurance on the line and the state doing it, really, for all intents and purposes, there's not that much difference in terms of your trust in the title, because you're fully covered if something goes wrong. And that is a paradigm where, in digital to digital bridging, you typically have a pile of money on both ends of the bridge that basically acts as stake when the items cross. I think you might see an architecture which is a pile of liability on the real world side of the bridge and a pile of escrow on the digital side of the bridge. And then items just walk backwards and forwards, anchored by escrow on one side and conventional liability on the other.
That's right. It's, instead of trying to prosecute truth, we're trying to prosecute a product, a financial product that is secure.
Where's the money?
Correct. Where's the money? Once you divorce yourself from truth and you start prosecuting something like profit, things become much easier.
Everything becomes probabilistic, and at that point, as long as you're pretty sure you have absolutely. So let's talk a little bit about what we see in terms of the future of the industry, right? We're in a position where the blockchain industry has run off the rails in terms of, trust in centralized infrastructure. Lots of discussions about what happens next and how do we prevent another FTX happening, deep transparency. The model that we've been kind of taking at Mattereum is that basically the problem is that we've had a phenomenally powerful transactional architecture doing kind of crappy transactions. The actual mechanistic software level has been relatively trustworthy. Nothing substantial has gone wrong. People have occasionally uploaded buggy smart contracts and have gotten a hit, but the platforms have not been hacked in forever. And now this question is, how do we get high quality assets and high quality transactions onto these high quality rails? And that was how we kind of framed it. Could I go sort of round table and just get everybody's thoughts on that, and then maybe we'll wrap? Yael?
Yeah. So in terms of mistrust of TradFi, I really don't think that that's a thing, frankly. I mean, people still mistrust crypto much more than their bank. By the way, it really depends which country you live in. And the same thing as discussion earlier about the title registry. In the United States, I don't think anybody will say, I don't trust the US government to, to keep my house and the title in my name. Whereas you can probably you could mistrust the due diligence done on the title when you buy a home. And that's why you have a title insurance. So I would say in the US, we're like decades away from having that on the blockchain because you just don't need it. But in countries in Africa or some other places where, somebody can just burn down the paper registry of some people's homes, then blockchain is better than anything that they have today, right? So it's all a question of alternatives, always. In terms of TradFi and traditional institutions, again, in the West, I think banks are still the most trustworthy institution, even with all the failures and fraud and whatever there is in the traditional world. FTX comes in the long line of fraudulent organizations that are super traditional, right? So, but again, I don't think people mistrust TradFi in any way or Western governments. And one last thing that I wanted to kind of mention is that sometimes when we say tokenization of assets, it might be a little bit of a misnomer because it's not like we're taking a home and like putting it in the metaverse, which is what it sounds like, or turning it into an NFT, or now it's magically tradable and or whatever, or even a title, when there's actually a process through which you could in fact use an NFT as a very valid way to transfer title in states like Wyoming, right? But basically, when we say tokenization, we usually mean putting contracts. Smart contract is at the end of the day is a contract. So creating tradable contracts, that's mainly what is done today in the concept of tokenization. And when we say this, everything like things like discussing whether real estate should be tokenized through an SPV or not, doesn't matter. Then it becomes a database problem, right? So we are tokenization of contract. How do you verify the ownership of the asset which contract you're selling?
Yeah.
Right. So if you have an SPV, it's super easy. You go to the, registry, the problem, the registry is not on the blockchain. So what do? So what we do at SolidBlock, in fact, we go and issue a QSIP as a, just in general, if you want, you can go to the SEC website and Reg D, like it's a special regulation. You go to the SEC website, you see all the trace, again, you still have to go and check the registry online for the corporation. So if it's on the blockchain, like in Georgia, of course, it's much easier for us. If it's on, like you said, some other jurisdictions where you can record liens or record ownership outside of an SPV, then it becomes a data problem. How do you verify the contract? At the end of the day, tokenization tokenization of contracts, one thing, tokenization of data, which I think John also spoke about, placing a bunch of things. I guess we could also say it's tokenization, but at the end of the day, you're moving all of the asset from Web 2 to Web 3. So you tokenize the data associated with the asset, which just basically means that anybody can go on a public blockchain, on maybe permissioned, maybe private with certain access. They can go and they can actually verify data related to that asset on the blockchain, right? So that's actually very, very useful. And so we can tokenize different aspects associated with the asset, right? We kind of have to be clear on what we are tokenizing.
Well, in fact, the UK, sorry if I may jump in there. In fact, the UK Law Commission has just put out, and not just a couple of months ago, put out a very heavy consultation document, over 500 pages, and one of the about how we look at how we view these kinds of assets within the law. And one of the proposals is that we create a new class of asset called a data asset. This is how they're describing it. So I thought
a new class of digital assets, or
digital asset, physical asset, data asset. So that's the proposal. It's interesting. We have to look. So I thought I would just add that too, because it sounded like what you were saying was in that direction.
Interesting.
Yeah, that document is huge, 550 pages, massive. Like even the table of contents is like, wow, this is. I mean, it's incredibly subtle and sophisticated thinking, and it's going to be bleeding through into UK law over time. This also puts me very much in mind of MERS, the data system that they use in the States for tracking mortgages. And the mortgages all get mortgage identification numbers, stuff like this. And, that to me is exactly the kind of resource for if there was a nice clean gateway between MERS and the blockchain, you could basically use MERS as an oracle. You would be able to get very, very, very useful data for de-risking transactions. And they could then take a transactional fee every time they're providing that data in a kind of registered way.
That's DART. That's the DART system that's meant to replace MERS. And clean up all of the sort of complexity with actually accessing the MERS information. And that's being done on the Provenance chain right now, as a matter of fact.
Gotcha. What do you think the timescale is for that to go live? And is MERS involved in building DART, or?
Yeah. So DART was an invention that came out of the founders of Provenance for the mortgage space. And I think, if I recall correctly, they have several billions of dollars of mortgages already recorded on the Provenance chain using DART today. And so, from my view, it's the quality of this data is what's going to inform the liquidity, and we want as much of it as possible. And so, to Yael's point, yes, we need that data to be digitized and tokenized. as the starting point so that we can apply smart contracts, right? And smart contracts are incredible because old contracts tell you what you would like to happen. Smart contracts tell you what is going to happen. And if they're done correctly and you apply smart contracts to this technology, to these NFTs with very good data, to Yael's very good point, you don't need these regulations because these assets will operate as God intended, as they were designed to operate. And so that also makes it a low bar to meet the regulatory requirements of any jurisdiction, because theoretically we should be operating so far above that level with a completely transparent, in real time, high quality data, publicly available, queryable blockchain, that those regulations are very easy to hit. But the one place where I disagree with you, Yael, is I don't think you should trust your government ever. I don't think you should have to trust anyone. That doesn't mean that we're trustless, but we should be trustless if we can. And there are, at these municipalities that we're speaking to today, 18th century titles in vaults, literal pieces of paper. You have to put white gloves on and wear like a bow tie to go in and touch, that are documents that are title and deed documents for some of these assets. And we're in the process of trying to figure out how to actually start to migrate these. These things didn't get migrated with Web 1. And the municipalities that we're dealing with did their last updates on their technology, on their databases in 1984 with COBOL as the language that was used, which is what my father used when I was a kid in the 90s. So there's a big leap here, and I think there's a lot of value in digitizing, tokenizing these assets, then applying these smart contracts and creating trustless, not trustless systems that I think will benefit everybody.
Yeah, I mean, the trick with all of this is always garbage in, garbage out. The fear that we've always had is that we're going to wind up with the data layer on the blockchain, gives you lovely descriptions of how everything is meant to be, and then you get kind of the Greek problem where you turn up in the village and you say, hey, the property registry says this. They're like, yeah, we haven't updated that in 70 years because every time you update the national register, you have to pay taxes. And actually, we have an informal local ledger that tells you who owns what, and all the transactions are done in cash. We don't know why somebody sold you the property on the national register. We would never do that. That's crazy. And, that thing of like how we maintain the link to ground truth, the Mattereum approach that we've always taken with this is that it's a liability question, right? What exists on the chain is a set of liabilities if ground truth is not as it's stated to be. And then the dispute resolution mechanisms that we put so much time into are how you square up the ground truth. You buy something based on data on chain, turns out in practice the building is not there, somebody has to be carrying the bag on that. And what you really want in chain is a very specific understanding of who exactly is carrying the bag and verifiable solvency that they can pay their bills. Because otherwise, how do we square reality up? Daniel.
Yeah, and I totally agree with that. And I do think, with this FTX debacle and some of the, downfall we're seeing out of this, there is definitely going to be resistance to trusted entities and centralized entities with any sort of token. I really don't see there being a point in the near future where you can fully eliminate that. With land and with real estate, there has to be a legal owner, and kind of a big piece for us, that universal transferability. I don't think that you can kind of fully take advantage of the existing DeFi ecosystem without that. So, you can't have a property that was mortgaged and then mortgaged 5 times over, or lent against 5 times over, default, have that chain of transactions happen and hit like a KYC accreditation wall each time. So I do think, as John said earlier, the tokenized piece of it being one for one really isn't a security. There's nothing that's happening from a perspective of like increasing the profitability or the value of that property, besides kind of the more macro effects of just the real estate market in general. So with our tokens, that is one essential piece, is that to buy one of these homes, you need to be able to avoid kind of the KYC accreditation, and it needs to be universally transferable. And kind of with the standard that we've released, there are fixed requirements for owning real estate. So kind of the way that it's laid out is we've taken an ERC 721 and we've added kind of a hashed operating agreement that has all of those legal rights kind of structured in there, immutable without consent from both the token holder and the administrator. there's the ability to change that legal ownership of the administrator, and then a payment mechanism and a repossession mechanism, right? Because if that property is changing ownership as quickly as, instantaneous transactions on the blockchain happen, and you need to be able to pay property taxes, you need to be able to pay, required utilities, there needs to be some, trusted component to that, because you can't have that updated, internationally 7 times over in 10 seconds, So I think that will remain in effect. And the Holy Grail is at a point where these systems, like John said, are eventually adopted and then looked back on by whether they be, property registries or county commissioners' offices for basically looking at the truth of who does own what. But right now it's going to have kind of that legal component that's attached to it. But hopefully, where we kind of see this going is the other component we have is that we have a set of 9 legal requirements that need to be met to meet the standard. And how you meet those, whether it's, an SPV with Wyoming DAO or some other way, is kind of irrelevant. It's more about meeting those requirements. And we really see those being kind of componentized. And then people being able to, look at a piece of property on the blockchain under the standard and being able to see, what are the standard components to that operating agreement? What are their liabilities? What are their legal recourse? How do they basically approach that in the event that they do want to claim ownership of this property? There is a default, etc. And that being much more easy to understand and kind of as this gets adopted, hopefully, there will be standard operating agreements that are set that are much easier to verify.
So kind of like template agreements that everybody understands, like you've got for say ISDAs right now.
Exactly.
Entire industry uses the same mechanism. Okay, you're doing real estate inside of the EU, you're using either contract 1, contract 2, or contract 3 for repossession. Almost like a sort of modular law approach.
Yes.
Super interesting.
Guys, you gotta be careful about selling these NFTs without KYC. That automatically makes it not a property sale. This property sale always involves in the US KYC and AML, especially online by brokers or anything else. That's number one. Accreditation, yeah, you don't need that because you are selling. It's not a security, but it is still it's an instrument. Well, it is an asset. You're saying it's an asset, it's not an instrument, right? If it was an instrument, then you would have to securitize it. So I would just check that, because then, when later on you come under scrutiny and there's, you're saying it's an asset, but asset buyers have to go through certain things and pay taxes.
But there's, for cash buyers in the US, FINRA has put in place some requirements on source of funds and KYC. I think particularly in like San Francisco, New York City, Washington, DC, Baltimore, a few places. But for the general United States, there's no KYC element, no AML element for purchasing property.
Okay.
Fascinating.
Super interesting.
Anton, are there any questions from the audience? Because we're at wrap this in a couple of minutes.
There have been
John Ennis has arrived.
Yeah, I'm very conscious of the time. Thank you, everybody. There are a couple of questions from the audience that I noticed. There was one quite early on from Matt Bishop. I don't know whether he's still on or not, but the panelists have touched on this a little bit, but perhaps we could look at it again. Matt asks, if you're tokenizing real estate, are you also lobbying, brackets, at least in the US, so the contract receives the tax benefits of, for example, depreciation for the new owner, or stepped up basis upon inheritance? Or are we just trading LLC interests, which are effectively personal property?
No, you're getting the tax benefits as an LP would in any LP interest in real estate. So this is the big difference between what we're proposing here and going and buying a REIT, for example. When you purchase a share of a REIT, you're being taxed on the corporate level. So you're getting, Delaware C Corp 21%. Then you're paying your personal taxes after that, and you don't get all of those benefits. You also are getting interest in multiple properties, and you're paying the expenses, the GS&A, for whatever that re-ownership structure looks like to go source those assets and do those deals. What we're all describing here is individual assets that you're purchasing a fractionalized share of and getting the tax advantages as an LP.
And with ours, it's a bit different. So this is something that hasn't been designed before, and the kind of the NFT's token structure that we have, it's not technically property, it's really a right to use that property. So the DAOs are actually they pay taxes as a corporation. They're tax neutral or tax negative, so there's no tax liability there, kind of on a yearly basis. And then it would make sense primarily not for a primary residence, but most likely an investment property, because with your primary residence, you can write off the first 250,000 in capital gains on your taxes. You can also write off your interest payments on your taxes. And obviously, we can't compete with the US government and provide those same benefits. So it would basically be taxed on the sale as a capital gain on the asset, right? So it's just on the NFT itself. There's no pass-through benefits or taxation benefits with the way that we've structured it.
Thank you. Yael, do you have anything to add to that?
No.
No?
No, thank you.
Okay.
We're good.
We have one more question, I think, for this panel, and then we can move on. So the question is, it's from Ben it's in chat, and the question is, how can projects working in the real estate tokenization space collaborate with each other on common standards and schema? Meetups like this are a great start. Is there anything more formal? Who would like to start? I mean, we've got folks developing standards. We've got people, obviously, who have been in the space for a long time. John.
Yeah, I've been trying to get a real estate NFT standards group going for a while. I'm gonna put it out here right now. Anybody who wants to join, let's do it. Let's just put it together now. Daniel, I want to try to use your standard for certain transactions. To your point, I think that the way that this standardizes is there's sort of like these open Zeppelin off the shelf, standards that you can grab when that use case presents itself. And so I think yours is fantastic for what you're trying to use it for. And I'd like to use that. I'd like to add to it if you're open to that, and invite you guys and anybody else to help join us and to create these standards.
Yeah, the standard we posted, it's in the draft stage, and they say, if you want a question answered on the internet, don't post the question, post the wrong answer. So we posted that answer, and it's up to you and everyone kind of attending this to go, review it, give feedback, improve it. It's definitely like we're looking for critical feedback on it right now.
Yeah, we've been looking at it. We've been looking at it just not just from the perspective of using it for real estate, but we think it might also serve quite nicely for vaulted assets like gold. With gold, you've got to do things like continue to pay the storage fees. You have to know who's going to pay the storage fee. And there's obviously all kinds of legal complexity about making sure that your gold is protected in case of bankruptcy, et cetera, et cetera, et cetera. So I think, we're going to come back to you with some feedback on that, but it may be that it actually has utility outside of real estate, because almost any physical asset has most of those attributes.
Yeah, that's kind of how we designed it. We designed it specifically for real estate, and if it can be extrapolated upon to, be improved for other assets, that's awesome. And I think like with really how it is designed, it's non-KYC, non-AML for the transfer of that ownership. But obviously, if we own a parent company that owns, a house, and you're going to come occupy that house and you have to get the keys, then there has to be some element of us basically understanding who you are to send you those keys, right? But it allows for that free transfer of ownership through, any DeFi protocol, any lending protocol, et cetera, which is a really important piece to it. But yeah, also, John, we will definitely be joining any events. Happy to co-host with you and kind of set up a committee. Ideally, at some point we're in front of
here we
US
go.
government.
Thanks, Daniel. Yael, anything to add on the standards?
Yeah, I mean, we're working super hard on the standards, and we are auditing, we're using a third-party audit companies to take a look. And the problem with real estate is that you have a lot of different models. And so smart contracts are super non-standard with contracts, right? Because as many contracts you have, or types of contracts, as many standards you'll have. With ownership, NFT might be different, even though you might own through an SPV or otherwise, and so on and so forth. For us, whenever, there are probably like 5 different models, major models of real estate. And, equity a leveraged, let's say, debt, you know, and so on and so forth, right? And then there's a fund model, which is actually probably going to be our most used standard, and that one is highly complex. Now, that said, I actually don't think the question is about that. I think, or maybe I can turn it into a different question. Number one, we're going to pretty soon, I was thinking about doing a meetup, a SOLIDBLOCK meetup, to show what kind of standards we came up with. And we actually are creating our own. Like just one contract is actually, one traditional contract is maybe 3 or 4 smart contracts that we are putting on chain. And so, you know, we're kind of creating our own standards as we go. And I would love for someone to come and review them and look at vulnerabilities and issues. That said, there's still a lot of unresolved industry directions that are super uncertain right now. Like what's going to be with KYC ML accreditation? Like it seems like there will be some sort of a few DeFi platforms where you can come and get kind of ID'd, like a DID platforms, then we'll be able to read from a smart contract, let's say that, right, part, instead of using our own kind of platform KYC ML and then placing this token in your wallet. That's the first thing. A second thing is burning tokens, for example. It's a super centralized feature, and that's something we've pioneered back with Aspen Coin. Now, it doesn't help anyone. Is there a different way to reset the tokens in an unlikely event of theft? What happens if you sold an asset? You know, because again, burning tokens is like an ICO era process that just, you know, should not be happening, because you wouldn't burn your house when you sell it, and you wouldn't burn your contract either, right? You kind of cancel that out. So there are lots of these processes that, frankly, like our devs are sitting there all day long thinking about, and it would be great to have a community. If you give us a platform, like if you give me a link somewhere where we can pose those questions for the community to come and kind of help us out, or together, you know, come to some sort of conclusion, that would be great for us as well.
Listen, I
really
really
good.
Very much.
Sounds really good.
I gotta say,
Sorry, guys, I'm very conscious of the time, and
Right.
there's still a little bit more to go. So thank you very much to our panelists. Vinay.
Fantastic. John, one sentence, you're midway through.
one sentence. You don't want to burn the token. You want the NFT to be the perpetual, infinite digital asset that persists. What's burned are the 1404s, which are the fungible interest in that asset. So that's the architecture that I'm going to propose, that we are proposing, and I'd love to talk to you guys more about that.
Great. Looking forward to hearing more about that. I mean, the more we can get the whole kind of physical asset story together on a set of interoperable standards, the easier it's going to be for that industry to expand rapidly, which is what we all want. Thank you all very much for coming. I feel like this was really phenomenally insightful. Really, really good. Thank you.
Thank you so much for inviting us.
Thank you so much, and please stick around for the after party. And before we move on to the after party, we have a fireside chat between Vinay and John Ennis of NEOSWAP. John, thank you very much for joining us. There is John's slide, and perhaps you can start by saying a little bit about introducing yourself, and then Vinay can ask you a few questions.
Sure. Okay. Well, thank you for having me. Thanks everyone for being here. So I'm Dr. John Ennis. I'm the CEO of NEOSWAP, where we are really pioneering a new form of commerce that takes us beyond money to a new form of kind of low liquidity commerce. And maybe when Vinay gets up here, we can show some charts to talk about what we're doing. But the basic idea is that through a combination of smart contracts and utility estimation, we can figure out how do you trade items around, how do you conduct complex multi-way trades so that everyone benefits. So maybe Vinay, if you want to come up here, we can start talking about it.
That's really good to see you.
Yeah, nice to see you.
Thank you for filling in. We'd been expecting one of the folks from SOLIDBLOCK to be here, and they had to drop out last minute. Very unfortunate. And so last minute we got John back. And hi, how's it going?
Yeah, good. Excited that we announced our partnership this week. So that's great.
Yeah, absolutely. So, I mean, let's frame this for people. I like to talk about NEOSWAP in terms of being it's a sort of fundamental economic mechanism design innovation along the lines of the inventor of the auction centuries ago. So the way that I describe it to folks is like, okay, so imagine that everybody bids on everything else in an auction, and most of the people in the auction are there to both sell some things and buy others, and they just go around and they attach a value to everything that they're interested in, and then the algorithm matches everything to everything and gets everybody the maximum possible value in the transactional cycle. Everybody agrees on it, the trades are executed, and it's one round, boom, you're done.
Yeah, let me show actually a chart that would probably help.
Yeah, absolutely.
Here's one. We've done many of these, done thousands of these trades actually. So here's a trade involving maybe about a dozen people, where you have a simultaneous exchange of kind of assets and your fungible and non-fungible tokens moving around in a way that benefits everyone. So there's an information gathering stage, which can come from events, which could be live events that are actually quite fun, multi-day events. There can be a standing market where people list items and people bid on items. We actually use AI to predict utilities, because one of the issues historically when you try to do this sort of thing is you have very incomplete information. And so we make predictions using AI to fill in the gaps. And then we're able to find these trades. And you can see that what's different about this and the way that commerce happens right now is typically people have things they don't want. They have to sell them. They have to create liquidity. There's a huge emphasis. We just heard a lot of talk about liquidity in the last session.
Yeah.
Big need to create liquidity to conduct
all liquidity all the time. I mean, and particularly in global recession, the whole global economic slowdown that we're looking at right now is going to make liquidity absolutely, at a premium in all of these arenas. Wow, so much complexity here. So when we start looking at physical assets and imagine them flowing over these kind of networks, particularly things like real estate, I can imagine something like this connected to the New York real estate market, right? And, you want to move out your house in Queens and somebody else wants to move into it, but, you don't want to live in their house in Brooklyn, and that place in Brooklyn goes to someone in Manhattan and you move into the Manhattan. Like right now in the UK, we have a lot of, thinking about things like mortgage chains. But in a NEOSWAP world, that's not a mortgage chain anymore. It's more like a mortgage web, and all of the people are kind of shuffling around. But it doesn't happen as a very slow process of A buys, B buys, C buys, D buys, A sells, B sells, C sells, D sells. It becomes this kind of simultaneous synchronized activity, which looks like it would be so much faster, so much more efficient. And access to that as an exchange technology seems almost like the point of tokenizing physical assets.
Mm-hmm. Yes, that you have this new, much more efficient form of commerce.
Much more efficient form of commerce. So it's not just that we turn the thing into an NFT and then the NFTs are auctioned. No. You turn the things into NFTs, so does everybody else, and then they go through NEOSWAP.
Yeah,
it just seems like such an improved way of doing business.
That's right. And so that's really, when you think about economic activity, right, it's about, to a large extent, reassigning ownership of typically scarce assets for mutual benefit. What is a good trade? It's typically a trade where people value the things that they get more than the things they give up. And so we're solving for that directly. Instead of going through that central bottleneck of liquidity, we solve directly. How do you reassign ownership? Now, maybe you make up the gaps. The fungible tokens or currency still plays a role in this universe. It's not barter, but moving forward from currency. So we don't go through the bottleneck. We get rid of the central market, really. And we just have this all-sided marketplace where items are moving around much more freely. So I think this is something new that Web3 really makes possible. And it's something that I think will be 5 to 10 years from now quite revolutionary.
I'm surprised you put it as long as 5 to 10 years.
Well, we're already using it for trading digital collectibles, and there is a market there. We just went live on Solana. We'll be live on Polygon later this year. We have been live on Stacks. We shut that down temporarily to focus on Solana. So for digital collectibles, digital art, there's already a use case. And we're starting to experiment with music. That's interesting. Now, we think games are a very big use case. So we think that there'll be value inside games. But when it comes, here Vinay's back. Okay, great.
Sorry about that.
The reason I say 5 to 10 years is because I do think you talked in that last session about some of the issues with the titles. One of the president of my other company lives in La Palma, and she's been trying to buy a house for a year. She has an agreement with the owner of the house, and there's, I guess, 3 courthouses, and one of them has a document that calls her house a shed, and they need to get the police person out to look at the house and say it's not a shed. Okay, now that person's been on paternity leave for the whole year, and so it's this giant mess. And I think that mess will just take a while to clean up. However, in some markets,
you know, in the elite markets, cleaning the things up and getting rid of those messes and then just plugging the properties right in. Like, you know, I always use this example of, penthouses in Miami. You know, and every time before Art Basel and every time before, you know, Bitcoin Miami, you get a surge of interest in Miami. A whole bunch of people are like, hey, we're going to Miami. And somebody is like, hey, I also kind of wanted a house down there. And you wind up with a round of flips before the events. Because if the transaction costs are cheap enough, if I'm going to be in Miami for a month for, you know, a bunch of Bitcoin events and a vacation,
yes,
I could either pay that as rent or I could sell that to be my first month of mortgage. And then I just flip into the property. And those kind of liquid, you know, dealing with real estate in this kind of liquid way, it's all about the transaction costs. And by far the best way of getting the transaction costs down is to minimize the amount of liquidity you have to access in order to be able to do the transactions.
Right. Right. You don't have that, in addition to other benefits like the time saving, not having to find buyers, all this. So
absolutely.
Yes. Well, you know, Adam Newman's new company, Flow, that they raised, I think like $350 million for. When you look at what they're doing, I actually think that's incredibly smart. They have these different properties that they purchased. You'll be able to basically buy into this network. And the idea that you would be able to give up your home in one part of the network and move to another part of the network, I think that sort of thing will become more commonplace. And when you bring something like NEOSWAP into a network like that, or maybe there is some centralized ownership, but people individually are able to live in different parts of the network, it's quite interesting. So I think that this reassignment of ownership is going to become more and more common in the future.
And, you know, this notion of doing it within closed networks, I think, is also very interesting from a legal perspective. So if you have something which is a kind of overarching entity, a little bit like a real estate investment trust, within which there are many properties, and those properties are being rented backwards and forwards by the people inside of that network, then the idea that you could run NEOSWAP algorithms inside of a single corporate shell as a way of reallocating interests inside of the shell, gets rid of the KYC AML problems, gets rid of the mortgage problems, because everything is being done inside of a single body.
And for training within a network, that's another thing, because we want to use AI to make predictions, right? And so we've been training, you know, within a particular NFT community or within a game or within an artist community. It definitely tames the problem if you are in a kind of closed network, because it's not reasonable to make a prediction. We have a bunch of data for you in one context. We're going to try to make predictions in some totally different context.
Yeah,
that's really
sense.
I think to do. So.
Yeah. But inside of these closed loops where you've got a long trading history inside of one place, makes much sense.
Yeah, especially when you've got on-chain data too, because you've got all sorts of information, not even about the people that were involved. You have these events, you have these trading events, but you also have all sorts of data from the community that's on-chain. So you can pull that into your training mechanism as well. Yep. So it's really ideal for training and machine learning algorithm.
So I want to talk about one slightly more philosophical issue, which is, what is liquidity? Because we use this term a lot. And every time I ask this question of finance people, generally speaking, they turn a slightly strange shade of purple. Because it tends to be in finance a little bit asking like what the question of what is love to poets or artists or mystics. So what is liquidity?
Yeah. Well, I mean, the definition that I know is it's the ability to transfer an asset into ready cash. That's the ability to make that, basically to go through that central mechanism. Because you think about it, money is this kind of central mechanism that facilitates economic activity. So that's why I say it's low liquidity commerce that we're doing, that we're not actually creating liquidity. We're making commerce possible in the absence of liquidity, or where there's very little liquidity that's needed.
Yeah. So the thing that interests me about this, question particularly, is that liquidity is both about pricing and time. It's actually kind of two variables. So in perfect liquidity, I can get access to an infinitely elastic market, so I can sell as much as I like, and it hardly moves the price of the asset. So, I have 1,000 gold bars, and I can sell 1 gold bar or 999 gold bars for the same price to a market that will simply absorb them. Branch one. And then branch two, how much of a delay is there? I can sell 1 bar a day and get full price, but if I sell 10 bars, the price drops. So, the ability of the market to absorb, incoming assets. And obviously real finance people have very sophisticated models of this stuff, and you get your kind of Greeks and demand curves and all the rest of that. But just this notion that if you have a much more efficient transactional architecture, it reduces the amount of time that it takes to sell the goods for a given amount of liquidity in the system. I just think of this as being one of these things where, as we change the rules of the game at a mechanical level, I just wonder if it actually changes the soul of the game in terms of our understanding of concepts like liquidity.
Yeah, that is interesting. We've been mainly working with non-fungible assets to a large extent, so relatively scarce assets, where it isn't the case that you're going to flood the market with your although we have had some examples in NFT communities where some people are trying to sell a lot of the same item and the market is essentially flooded. So that does happen.
Absolutely. It does happen.
That's interesting. Okay, I'll think about that in terms of
because the problem that we have describing the potential impact of NEOSWAP is if you say to people, imagine the auction. The auction is such a fundamental construct. Right up to the point where in law, when we try and figure out what something is worth, one of the things we say is, well, if you have an auction, how much will it sell for? Right? It's like a fundamental primitive. In a lot of ways, value equals price at auction in a lot of sort of mechanistic legal processes. And when you say value equals price at auction, but if you put it through a NEOSWAP system, you'll get 10%, 20% more for it. It begins to move value from being decontextualized in an auction setting to being fully contextualized in a swap setting. And sorry, go on.
Well, one of the things that's interesting about NEOSWAP is we really have individualized prices, that you've got each person is willing to sell their items for some amount and they're willing to buy other people's items for a certain amount. And what makes a trade happen is when items are willing to be, some people are willing to buy items for more than people are willing to sell them. So which is okay because people are trying to sell them or trying to get rid of them. So in a NEOSWAP event, when you have a particularly good trade, what happens is everyone in the whole network feels like they're effectively selling at what they would call a high price for the item, and they're buying their items at what they would consider to be a low price. But that definition of high and low price is subjective, right? It's varying with the person. So that's why you get the kind of magic trick where everyone feels like it's a good trade because you've managed to match up those differences, those the differences between people in terms of
it's fully contextualized.
Exactly.
So one last question before we head into the after party. Tell us a bit about the partnership with Mattereum and what you think it's going to enable.
Okay, well, I'm very excited about our partnership. I think that, for example, the wine tasting and the wine trading is really very interesting because at the beginning, when we are training our algorithm in particular use cases, the live events are going to be very helpful. And I think they're going to be fun. People will be surprised at how fun the events are. We have live chat within our rooms, like audio chat, we have text chat and audio chat. So people get to know each other, talk about the items. Eventually we may have video. I mean, we've actually done some trades in VR. So the idea would be you're going to get together with the people in some environment, we're going to say local. It could be, conceptually local that you have shared interest. When you get together, you're going to get to meet people and you're going to be able to buy and sell your items. One big difference between NEOSWAP and most of the way auctions are set up right now, and in fact, Web 2 in general, Web 2 tends to be focused on two-sided marketplaces where you have buyers and you have sellers. Okay. In this new world, you've got everyone is an economic agent. So people are buying and selling at the same time. And we will also be getting services involved at some point. So that's something interesting. So I think the work you all are doing is incredibly important because you're right at that kind of nexus. Like you're right at the intersection of the physical and the kind of Web3 space, which is the link that we need to unlock all this value. That we start with wine trading. That's a huge market. I think you were telling me, I don't recall the number.
Enormous. I mean, wine people love nothing more than flipping wine. You buy 12 cases, you drink 2 cases, you gift 4 cases, you sell 6 cases. This ability to just get lots and lots and lots of interesting things to drink from friends and to offload the stuff that you bought and it wasn't quite what you hoped for.
Right. But someone else might like it.
And well, because the wine tasting is the people's taste in wine is so particular and personal, it seems to be like a perfect use case for creating this kind of extremely large trading surface without people having to then come up with 10 grand every time they go to a wine auction.
Right, exactly. Yeah, that's right.
Friends, I'm very conscious of the time, and I think there will be, John, if you're able to join us in the after party, hopefully there'll be an opportunity for folks to connect with you directly there and ask you some questions.
Can I answer the one question? Anton, there's one question in chat, if I can just answer it very quickly.
Sure, of course, please do.
Okay, because at what scale does it start to work? Well, actually, even with 2 people, there can be value. Because suppose Anton and I are going to trade some NFTs with each other. Well, you might have 10 NFTs that you're willing to sell, Anton, and I have 10 that I'm willing to sell. We can get together in just a one-on-one party, and you put your items in the room, I put my items in the room, you set your prices, I can pick which ones I would pay those prices for. Conversely, you pick from among mine, we set a spending limit, and then we'll get a trade, the best trade between the two of us. And it could be 7 for 10, something we would never find, but the two of us get a trade. So even with 2 people, you start to get some value. But then typically parties are 20 to 30 people, and then the network can be much larger. And I can talk about how we scale it. Okay, but even with 2 people.
Thank you.
Thank you so much. Okay, so there is thank you so much to Toby, thank you so much to Yael and John and Daniel, thank you to Dr. John Ennis for that wonderful fireside chat. We're going to head over to a separate Zoom link now, which is the after party. Now everybody should have who registered for this event should have it in their email. If you don't, it's been posted, the link to it has been posted in the chat a little bit further up if you scroll up, and it's just been reposted as again. So please head on over there, and please don't forget to collect your POAP, your proof of attendance protocol NFT, which shows that you were here at this event live as it happened. The link is also in the chat. Thank you everybody so much. Really looking forward to the after party and the open format conversation over there. And we will see you at the next, if you're not going to join us at the after party, we'll see you at the next Mattereum physical asset NFT meetup, or perhaps even a bigger event sometime in the new year. Thank you so much, and hopefully see you at the after party. Bye-bye.
Yeah, bye,
Sure. Thanks again, John.
Thank you.